I've had this theory for a while that if you really want to know about a person, you meet their partner, their spouse, their significant other, and see who they are and how they carry themselves and how they manage their emotions and how they treat their body and their health. And that will tell you more about that other person than if you knew them or asked them questions directly, because that person is a reflection of who the other person really is. So as I've gotten married and had kids, I still have that belief, but my add-on belief now is if you want to know what type of person someone is, you look at their kids and you see how their kids manage themselves and how their kids handle situations, and that will tell you a lot about who that person is, probably even more than their spouse, because kids do something like they really, at least for me, having kids has been very difficult and exceptionally rewarding because, they know how to push your buttons. And they know how to push your buttons because they put those buttons there. So it's really good for you to find out where your weaknesses are by having kids, or you could see the areas of your improvement. So I was reading, I do a lot of, I'm kind of a lifetime learner, and I've just recently been reading a new parenting email, and it said, the 10 things that make a great parent. And the first one was, of course, don't hurt your kid, which I don't think that should have even been on there. But it was number 2 and number 3 that I thought were really interesting. And it was the number 2 and number 3 on the list that helped me bring up and get the theme for this week's podcast. Hey everybody, this is RC Peck, and this is my weekend podcast. I am talking to you 2,935 miles west of Wall Street here in Silicon Valley. And the theme for this weekend's podcast is the number one rule of investing. And it's also the number one rule of parenting. If you take out the first rule, which is kind of silly, I'm assuming all parents know not to hurt their kids. But the number one rule of parenting and the number 2 rule of parenting is all around checking in and managing your own emotions. So literally the first rule is check in and just see what's going on internally for your emotions. That's number 1. And then rule number 2 is manage those emotions. And I think that's also true for investing. Step number 1 is step inside or notice what type of emotions and feelings you're having. That should be number 1. And then number 2, manage those first before you buy or sell anything. So with that, there are 3 things that are at extremes. I mean, absolute extremes that I want to share with you. And because these 3 assets are at extremes, it can be really pulling on people's emotions. So we really need to step back and check in with ourselves and manage our emotions and get the big picture. So I want to do that with you and show you 3 assets that are at extremes. The first one is oil. Now, this image you see here has a top chart and a bottom chart, which almost look identical. The top chart is the price of oil over the last 21 years. And the bottom chart is the percentage the price of oil is away or far from the 200-day moving average. So how far away is it from this 200 period moving average? And as you can see, back in 2009, oil was 50% away from its 200-day moving average. That's huge. That's huge than what it usually is. And back in 2008, it was 100% away from its moving average of what it usually was. So that was a very extreme move. And what we have today is oil looking like it's going to head down to the $40 mark, which it was at in 2009, which stretched oil, the price of oil, 50% away from its 200 period moving average. And here we are today. We have oil heading lower, and it is still not at extremes from the point of view of how far it is from its 200 period moving average. If you can see that in the lower right, and your screen might be small, but in the lower right corner of the screen, you see the percentage or how far the price is away from its 200 period, and it's not at that 51% level yet. In fact, it's at 48.5%. not too far away from extremes. The point is, it can get worse for a little bit for oil, moving at these extremes, and we have a pretty solid support right around the $40. So there seems to be a very high probability that oil is going to come down and touch and check out what happens around the $40. And then, of course, I'll be watching it and giving you updates on it. But that's really the next major place for oil. And the reason why oil made this list is because of the extreme distance it's away from its 200 period moving average on this 21-year price chart. The second asset I want to show you is gold. Now, this actually is not a price chart of gold, but it's a price chart of precious metal mining stocks, the XAU. XAU is basically the S&P 500 of gold stocks. Again, at the top you see a price chart of XAU, and at the bottom you see how far XAU is away from its 200 period moving average going back the last 21 years. Now for this, if you look to the low right corner of the chart, you can see that as of today, or actually Friday, XAU is 44.6% away from its 200 period moving average. It's been at bigger extremes, but at least over this 20-year period, it hasn't ever gone more than 50% away from its 200 period moving average on a weekly chart, which it got to that number at the end of 2008, and it got to that number in 1998, and it touched it barely at the end of 2014, and it looks like it's going to go back down and touch it. What concerns me the most about gold, at least precious metal mining, is if you see this red line up here on the price chart, the price of XAU came down, broke below this, came back up and hit that, and then moved back down. From a technical point of view, that is more of a weakness than a strength, meaning it's going to want to move down farther. And it's already broken below its weekly low in 2008, which is a bit of a concern. And there's a lot of space down here below its next major support, which is way, way, way down here and way back in 2000, which it hit a bottom of 44. So more weakness in gold, more weakness in oil. Those two are at absolute extremes, as you can see in the lower section of both screens, that they are literally at 21-year extremes, moving away from that 200 period moving average. And one of the reasons why this is happening is because of the third chart I wanted to share with you, which is the US dollar, that is absolutely screaming higher. And over this 21-year chart, if you look at the lower chart and to the right, you can see that the US dollar over the last 21 years has never been this far away from its 200 period moving average. So we are looking at something pretty abnormal over the last two plus decades. Doesn't mean it can't go more extreme. It's absolutely gone parabolic. It can go more parabolic. And there will be a point where it has to settle down, even if it wants to go higher again. And of course, the inverse of this price chart is the euro rapidly hitting $1 US to 1 euro. Though that's not its historic low. When the euro came out, it would only cost 88 US cents to buy the euro. And if you did compare the US dollar against the Deutsche Mark, or the German mark, which a lot of people consider that a good placeholder for where the dollar could go, it could go much lower than that 88 cents to the euro. So we have three major assets in the world. The most traded currency on this planet, the oldest traded asset on this planet, gold, and the most traded commodity on this planet, oil. All three are at extremes and getting close to potential pivot points. Now, the big takeaway, or some things that I want you to take away, is we are absolutely at extremes. That means, in some ways, nothing, because we can get at greater extremes, but this is something just to take notice. And I believe that a big part of these extremes is all the money printing and manipulation that's happened over the last decade. And no, this is not something new. There's always been currency manipulation over the last 2,000 years. But this is part of the reason why there's so much volatility in prices, which may not have been there. But we are absolutely at extremes. So be patient. Check in with yourself first, see how you're managing your own experience, and really look to stick to your strategy. And that's why strategies are absolutely the foundation of how well you grow your money. And then, if you can, avoid the news. News will almost always make you do something bad for your money. Hey guys, this is just another step in helping you secure your portfolio and your future. Until next time, this is RC Peck.